Welcome back. Stocks in Asia fell ahead of the U.S. Federal Reserve's interest rate decision set to be announced later. The Nikkei in Japan slipped 0.5%, and earlier data showed Japanese retail sales in September surged 9.1% as compared to a year earlier, above expectations of a 6.9% increase. The jump in retail sales came ahead of a tax hike that went into effect on October 1st. Meanwhile, mainland Chinese shares finished their trading day lower, with the Shanghai Composite slipping 0.5% to around 2,939 points, and the Nikkei shedding 0.6% to close at 22,843 points. The Hong Kong's Hang Seng Index shed 0.4% as its final hour of trading. Looking at the U.S. markets, the S&P 500 edged lower to snap a four-session winning streak yesterday and retreated from a record high as investors grappled with a flood of earnings and the latest update on a potential trade deal between the U.S. and China. The Dow Jones Industrial Average fell marginally to close at just over 27,000 points. The S&P 500 was flat, closing just over 3,000 points, and the Nasdaq Composite dropped 0.5% to 8,276 points. Well, locally, the JSE opened lower this morning, tracking Asian markets as investors again wait for that U.S. Federal Reserve's monetary policy decision. Markets have priced in a 25% basis point cut from the Fed's second last meeting for the year, which would make it the third cut from the Fed in 2019. Let's have a look at how some of these global developments are outlined in the markets. Well, to unpack the markets for us, we are joined by Makwe Masilela from Makwe Fund Managers. Thank you so much for your time.
Pleasure.
Let's go through the JSE's market performance. I mean, I mentioned a bit earlier on that it opened lower. Are we looking better at this stage?
We are, to think that around 10-ish, or just about 10:30, we were down almost 600 points. So now we are down just around 240 points. So at least we managed to recover most of those losses. But I think it's just a general global trend, because even if you see the European markets, they're also mixed. And also if you look at the futures when it comes to the US, they look as if they're going to be opening down. And I think it's a question of, for the past few days, we've been very hopeful that come next month, the US and China will be able to sign that phase one or mini trade deal on the sidelines of that Asia Pacific summit which is supposed to happen in Chile. Yeah. But now we just got some reports from Reuters stating that they're having a problem, the US and China, because Donald Trump is busy trying to push that the Chinese government must make sure that at least they buy almost 50 billion worth of agricultural products coming out of the US. So that seems to be a sticking point. And all along, everything was happy. We were all happy. Donald Trump also commenting that, hey, it seems as if the deal is ahead of schedule. Washington officials also stating that, hey, it looks as if, even the extension of the suspension of the tariffs, is going to be extended, stuff like that. So it was all positive, because if you think about it, all along markets have been disturbed by all these headwinds, the trade tension between US and China. So when we saw that at least there is some de-escalation when it comes to that tension, markets were going up.
All right, let's stay with the U.S. I mean, everyone's looking at the Fed policy statement later tonight. And you sort of get a confusing picture when you look at the U.S. economy, because on the one hand, latest economic data that has come through show that, there's something happening in the economy, but you can't really pinpoint whether a recession is coming or not. And on the other hand, when you look at U.S. earnings, most of them have come in better than expected. Are you also one of those who are in the camp that is pricing in a 25 basis point cut?
You know, it's all in the asset prices already. You know, I think the biggest question for us is the statement, you know, coming out of the chairperson. And if you look at the December meeting, you know, at some point, we're expecting almost 70% that they will cut again. Now we are sitting at almost 23%. So it shows you that we are not too sure about the whole thing. But yes, going to the earnings, that's what's supposed to be driving the markets. And obviously, as analysts, always our expectation were a little bit low. So they managed to continue to beat those kind of expectations. But yes, the mainland or the mainstream economy of the US is not doing that well. But remember, we're looking more at the PMI numbers, forgetting that manufacturing also only make only 11% of the US economy, which is below 50. But you look at their services, though it's still going down, but it's still above 50. So it tells you that the US economy is not yet, you know, at the point where it will dip into a recession, given that the manufacturing, which is below 50, only accounts for only 11% of the economy.
Locally, we are expecting Finance Minister Tito Mboweni to obviously deliver his medium-term budget statement. And whether you look at, the Fed policy announcement or the budget statement, either way, we're going to see some volatility around the rand, depending on what the tone is and what is said. From your side, expectations that you are looking for in terms of what the minister should be saying?
You know, we hope that it's not going to dwell much on bailouts. We already know all about that. He must at least present that last version of his economic policy, because the worrying part here is you are sitting with a situation where your debt is going up, your economy is not growing, so you're going to have a challenge. How do you repay that debt? Because people are already talking that it might reach 60 or 70%, and here you are, you're expecting your economic growth forecast, you're busy lowering that, and then you expect him to tell us that probably the economy will grow at 0.6%. And I think that's the main thing that what ratings agencies look at, because they look at your credit, that are you able to repay whatever credit people have managed to give you. And we only know the only way you can repay that, that's if you start collecting more revenue as your source of income. And so far we know we've not been doing well, and now that's going to be the biggest question. And also when it comes to cutting expenditure, I mean 2015-2016 financial year to 2019-2020, you look at the wage bill, it increased by whopping 152 billion.
All right. So locally, we know that the economy is very weak, and some of it probably is triggering the sentiment around the JSE. A lot of traders you speak to talk about the kind of volume we're seeing on the JSE, that it's not what they're used to. In fact, some of the volume, the numbers, it's pretty much what you would generally see around the December period. What do we need in terms of a catalyst to drive that nice volume that we're used to seeing? And perhaps from your side, how do you then balance market sentiment, which can appear to be negative, with company fundamentals, not throwing the good companies out with those that appear as bad companies?
Truth be told, I think company fundamentals are out of the window. Markets for the past year or so, and even international markets, have been driven by politics, which is not the right thing. And with politics, it's very difficult, unlike if the markets are driven by economic factors, because you know what intervention needs to be done to rectify a particular situation. Yes, for now, markets unfortunately will continue to be driven by that. And unfortunately, investor sentiment is not looking okay when it comes to emerging markets. You look also at tech as well. People are not trading that well. So unfortunately, we are part of that basket up until globally sentiment starts to be positive, and back home here starting today, we do what is required to start encouraging investor sentiments to turn positive. Then maybe that's when we'll see people starting to put their money in, because people are sitting on cash, and I think it's a safe bet for now.
Makwe, let's leave it there. Thank you so much for your time. That is Makwe Masilela from Makwe Fund Managers, unpacking the markets for us. After the